So good morning, everyone. I see the attendees and people are joining us as we speak. I'm going to allow 1 or 2 minutes as all the attendees join prior to starting this, but I want to thank you all for joining us. And we're just going to go on to mute for 1 more minute.
Dad, my video is not working.
Dior, can we help David to make sure his video?
Yes, just make him co-host.
Okay, all right.
Mine's not working either, just so
Yeah.
you know. Yeah.
Yes, I'm going to.
Yeah.
Now it's working.
All right, well, good morning, everyone. For all our attendees, it's 11:01, and I think we'll get started. I anticipate that I continue to see attendees joining us, and I want to thank everybody who has already joined and for everybody who's joining. For those of you who do not know me, my name is Odette Orgill, and I'm president of the Canada-Israel Chamber of Commerce, and it's my great privilege today to host and moderate this event. Today's event is very timely considering over the last little while we've seen many companies, both large and small, access the Canadian public markets. We've got a wonderful esteemed panel who will talk with us from various angles about the different ways that companies can access the public markets here in Canada. I want to take 1 minute and thank Lior Abramovich, who's the Managing Director of the Canada-Israel Chamber of Commerce, for all the work he's done behind the scenes to get this event up and running. So without, I apologize. Let me first, for those of you who don't know, what is the mandate of the Canada-Israel Chamber of Commerce? So our big objective, our overall objective is to promote bilateral trade between Canada and Israel, between these two great democracies and capital markets countries. We do this in a variety of manners, whether it's through Zoom events such as this, virtually, and the hope is that come the second half of this year, we'll be able to see many of you in person at a variety of different events that we host. So as I said, without further ado, I'm going to introduce our esteemed panel today. I'll start with Jason Saltzman. Jason is a partner at Gowlings here in Toronto. His practice is in corporate finance and securities law with an emphasis on securities offerings, mergers, acquisitions, private equity, and venture capital transactions. He also has strength in corporate governance, securities registration, and compliance matters. Jason works with established as well as emerging companies worldwide, primarily in the technology, fintech, clean tech, cannabis, and life sciences space, as well as mining resources, media, esports, and entertainment sectors. Quite an array there, Jason. He assists issuers, investment dealers, institutional and private investors on a variety of complex private and debt financing transactions, right from startup to venture capital, private equity, and what we'll talk about today, larger public offerings. He's taken a number of companies public on the TSX Venture, and the Canadian Securities Exchange by a variety of means, whether it's IPO, reverse takeover, capital pool transactions, and direct listing. He advises on corporate governance, disclosure obligations, securities issuance, and executive compensation matters. He also will advise securities dealers, advisors, and investment fund managers and other market participants in connection with their registration and compliance issues. Jason does travel a lot to Israel, we know that, and he helps them on assisting in raising capital for Israeli companies on the Canadian Exchange. And he currently co-leads the Israeli country desk at Gowlings. Our second panelist, David Danziger, is a Senior Vice President, Assurance and National Leader for Public Companies at MNP. He's also a member of the firm's management team and is responsible for providing leadership and direction for their practice across Canada. David has extensive experience in both Canadian and American public market transactions and leverages his significant experience having served as a director on many public companies which have been listed on the TSX, TSX Venture, CICC, and the New York Stock Exchange. David's been in the business since 1980 as an accounting professional, and he serves as an audit partner, compliance advisor to public companies, as well as private firms looking to go public. He brings many years of experience and practice to a number of complex and significant transactions, assisting them on their accounting and regulatory matters, as well as on prospective filings and other public documents. He's also a member of the CPA Ontario Practice Inspection Committee. He's a past member of the OSC Commission's Small to Medium Enterprise, and is a past member of the CPA, PDA, IFRS Task Force on Mining. And our third panelist, Mark Francis. Mark has a passion for small capital markets. His primary engagement currently is an advisor to the Canadian Securities Exchange, which is today the world's fastest growing stock exchange for small cap issuers. He also advises independently other small cap growth companies. Mark currently also has interest in other entrepreneurial projects, including mineral exploration and several angel investments in industrial innovation technology through the Valhalla Angels. He also leads the East Africa Opportunity Corp, which represents a group of investors backing entrepreneurs in the developing world with businesses ranging from engineering and construction companies in South Sudan to a Wi-Fi company in Jamaica. He's also part of a group launching an environmentally friendly processor of artisanal gold ores. So thank you, all of you, for attending today. I'm very thrilled to participate and to moderate this event. For everybody who's watching, this event really is going to be more of a fireside chat. I have a number of questions that I hope that our panelists will be able to answer individually. In addition, if you have any questions, please put them on the chat. We'll try to get to them, and I think we'll look forward to really just a very informal exchange with these three individuals. So without further ado, my first question, and I'll just start with Jason as he started, is Jason, why would a company bother going public?
Thanks, Oded, and thanks to the Chamber for hosting this great event. And it's great to see everybody in this forum. We're used to holding Chamber meetings at our offices in Toronto, and hope that we can one day get back to that. But thanks for the reason to put on a collar and a jacket today. So looking forward to this discussion. So your question, Oded, is why would a company want to go public? And going public is a great way for a Canadian or even a non-Canadian company to raise money. Many entrepreneurs who are have started up companies and are emerging in their growth are looking for ways to access capital, and going public is a great way to do that. In Canada, we don't have such a large venture capital community as they do in the United States and as they do in Israel. So many smaller companies actually go public at an earlier stage in Canada. We have a whole infrastructure that is set up to allow for that. So companies, even at very small valuations, can go public on different stock exchanges and different tiers of the exchanges. So it's a great way to do it. So I can go on, but I think others might want to answer this question as well.
Yeah, David, is there anything you could add to that?
Sure. Again, echo Jason's comments. Thank the Chamber, and I'm very happy to be here on this panel today. Very exciting and bound to be very interesting. So I guess just to add on to Jason's comments, there are a number of reasons why people would consider going public. Expansion capital is the obvious one, and particularly when the markets are as frothy as they are today. And you see, even for particular segments, that there's a lot of money on the street. It's very hard to look away from because you just don't always get that opportunity twice. And then I think, more mature companies that are looking for a potential exit strategy, going public and being on the markets for a while is potentially a good one. Avoids having to find a private buyer at some particular point in time, perhaps, and may get a much higher multiple a lot easier.
Sure. Yeah, Mark, I know you probably could add something. Please do. But let me ask you something. As as a representative of the Canadian Securities Exchange, which has a lot of microcap companies, are there instances where companies maybe not want to go public? But please add if there's any comments you want to add to what David and Jason said, but talk a little bit about that.
Yeah, I'd like to add a few things. One is that, you have to look after your existing shareholders. So if you're private, giving them liquidity is relevant. And David's right, you can get a higher, usually throughout the average of a cycle, a better valuation for your business. And I do want to touch on the good reasons to not go public as well, or considerations. But another very good reason is that shares can be used as currency. So if you want to be an acquisitor or do tuck-in acquisitions, having liquid shares becomes a very appealing tool for acquiring other companies. Another thing it does is it makes stock options tangible for employees. And especially for tech companies, that can be quite relevant. And we went through this valley of death where after the dot bomb, where people said tech companies shouldn't go public. And as I was trying to tell people back in 2005, and I know David believed it, and I'm sure Jason did, although we didn't know each other at the time, was that the reason we had that huge run up was because public markets worked so well for tech companies for 100 years when you go back and look at it. So then we had this feeling that they didn't work, but in fact they do work, and they are working again for tech companies. So those are two important considerations. But you have to first think about a couple of other things. One is, do you actually intend to do a private M&A exit in particular as a tech company looking to be bought by a large entity? Because if that's your objective in the next 2 years, becoming public can make it more complicated to get bought out. Obviously, if you're Canadian, loss of shred is very relevant, and there can also be the distraction issue. So there are reasons, but cost should not be one of them. As David and Jason both pointed out, small companies can go public in Canada. We've become very efficient at it, from the legal advice and the account auditing that has to go forward to other things. We are the most efficient in the world with small cap companies.
Great, thank you. Jason or David, is there anything you'd like to add? Please.
Dan, I'll throw in just one more thing, and this is certainly particular to the sector that you may be in, but, we find, I think, more and more often that there are, new and novel sectors coming to the market, like cannabis, like psychedelics, like crypto mining. None of those would really be appealing to a bank or other form of, lender. So it'd be very, very difficult for them to raise money in anything other than the capital markets, which affords them wild opportunities to actually raise vast sums of money.
Well, yeah, that's an excellent point. Thank you. So let's get right to it. I mean, the topic of our session today is different ways for companies to go public. I mean, and I know all of you, Mark, you've seen them all come to you, and Jason and David, you've been working as they go. So the most traditional form, and David, I'll just ask you to start, is what's an IPO, an initial public offering. Maybe if you could, just from a high level, talk a little bit about that and how that particular one works.
Sure. I guess an IPO is probably the oldest way in the book to get through and become a public company in Canada, or for that matter in the United States as well. An initial public offering is just that. This is a first-time offering for a private company going public. That would be, a company that doesn't already have the requisite number of shareholders in its base, which for purposes of the CICC would be 150 shareholders, needs that distribution, needs to raise money, and is going to find their way to do that going directly to the regulator, to one of the securities commissions, be it Ontario, BC, or otherwise. And we'll have to file a preliminary and final prospectus with them, respond to all their comments. I'll let Jason expand on how difficult or easy that is. And then at some point have a simultaneous application to an exchange in order to be able to trade. So it's kind of it's a two-pronged event, but the main event is actually dealing with the Securities Commission and getting through that process, along with having your underwriter, which which is, a series of groups who will help you raise the money, put the investors into your deal, which then creates your shareholder distribution base, as well as funds the outcome. And there's a lot to that. I'm going to leave that there and let others contribute, because it's a wide ranging topic, with all of the various interplayers that have to get involved in order to make this work. It sounds easy, but there's a lot of moving parts.
Yeah, well, thank you, David. Jason, did you want to add something?
I'm just going to say I'm glad this is being recorded, because David's rendition of the IPO that was probably one of the best explanations I've ever heard. So thanks, David. Well done. I'll just add to that and just focus in on the prospectus document. So
Sure.
David mentioned the prospectus, and the prospectus is like a book that contains full, true, and plain disclosure of all material facts relating to the company. So it's a disclosure document, but it's also a marketing document. It's what's used to sell the securities, but it's also what's used in a very defensive way to provide full disclosure about the business. So when we talked earlier about, one reason maybe not to be a public company is that you're pretty much opening the kimono and putting everything in that prospectus document. And investors who purchase securities in reliance on that prospectus, they have rights of action against the company and any selling security holders if it's a secondary offering, as well as any underwriters that sign the prospectus, and subject to the defense of due diligence. And there's a whole process that leads up to the filing of the prospectus, which is the due diligence process, where every single word in the prospectus is backed up by a piece of paper or some kind of industry statistic about the business or industry sector that the company is involved in. There's full disclosure about the management and the board, any litigation against the company, any intellectual property that the company may have, any real estate, about the employees, you name it. Then there's also a whole financial piece, which David knows quite well, about the financial statements for the business and management discussion and analysis and whatnot. And that all forms the basis of the prospectus document. And so you're looking at quite a few weeks, maybe 3 or 4 weeks, to get ready to file that prospectus, dotting the I's, crossing the T's, drafting to find that perfect balance between investor protection and the marketing piece. So that's the key part of the IPO process.
Great, thank you, Jason. Mark, did you want to add any comments just on the IPO? I mean, as we'll get into some of the other aspects. Anything from you?
Well, just to say that the most important point is to pick your good advisors, your legal counsel, your auditor, and those are very important. The one thing I would add that I like about an IPO ties into what Jason talked about in terms of it being the selling document. With an IPO, everyone you bring into the company, you bring in. And so they believe in your story. And the IPO works best of all when you have relatively stable markets, not markets where everyone is skittish or afraid the party's going to end in a hurry. And this will tie into where you take us with the other options as well. But I really do like that aspect of an IPO, because you have to get out and you have to tell your story and tell it generally fairly broadly. And in the act of doing that, you create a longer term, sounder base, shareholder base.
So the first thing, before we go on to the next topic, I want to thank the three of you, because every one of these things we could probably talk several hours on. So the ability for you to summarize and bring a few key points in 30 seconds really shows me that you all know what you're talking about. I'm very appreciative. It'll help our audience. So we've talked now about the IPO and again, the prospectus. One method of going public in Canada that I know historically has been very popular is the reverse takeover, or the RTO. And again, I think that this is something that we've seen a lot of. And maybe Mark, I'll start with you. You commented a minute ago that the IPO is something that is often very good in more stable markets. Why would someone look at the RTO, and is it very dramatically different maybe?
Well, Canada's probably the world champion for RTOs. Jason and David likely know better, but I'm just going to guess that we are the world champions at it, right? And we take the crown, and even SPACs are modeled on our wonderful models. But having said that, a very good reason to do an RTO. First of all, a lot of cannabis deals and blockchain deals use the RTO because, and I'll let Jason and David talk about the issues that related to filing a prospectus with the commission, certainly in the early days. But the better reason is that you can do things such as close in escrow, your financing in escrow. So if the money is there and you have a shell or a deal on the other side, you don't have to worry about getting that process done. You know you can get the deal done and you can put all the pieces together. Having said that, I'm going to turn it over to Jason and David. So
Sure. Jason, do you want to start?
Yeah, sure. Thanks, Mark. That's great. I'll just step back and maybe define what an RTO is for those on the call today. So an RTO is when you have a public company that may or may not have a active business. Like it may be an old mining company with some properties in it from many years ago, but it attained the status of being a public company because one day in its life cycle, it went through this prospectus process or an IPO process or maybe another RTO or other public process. But the company is a public company. It's referred to as a shell and very colloquially because it is actually what it is, a shell. It's got no active business in it. And its sole purpose is to find an active business to acquire. And what happens on an RTO, it's a reverse takeover. You have the shell company taking over the private business, and it's called a reverse takeover because the shareholders of the private business end up taking control of the public shell. So, you merge the two together. It's usually structured in the form of it could be a merger, like an amalgamation or a plan of arrangement, which is court approved, or it's a straight acquisition called referred to as a share exchange, where you have the public company acquiring all the issued and outstanding shares of the private business in exchange for a control position in the public business. And those are sort of the main ways of doing it. All exchanges in Canada have policies that enable this type of situation. Mark alluded to the SPAC, which is it's effectively an RTO. It's called the Special Purpose Acquisition Corporation, a public company that acquires private companies, and that's a very common way of going public.
David?
Yeah, I would add it's so common, and I'm not sure what the numbers were this year, but I think it's something well north of 80% of the go public transactions in Canada are actually done through an RTO. And it's God's wonder that we have that many shells that are available, but we seem to, and people always seem to be able to find one to enact the transaction. The other thing that I would say is, and I don't want to bore anybody with too much accounting here, but I think it is important to note that when you engage in an RTO, what happens to make it look rather seamless is that the RTO acquirer, namely, your business that's engaging in this reverse takeover transaction, its own history goes forward with it from an accounting perspective. So when you're looking at the financial statements the day after you do the transaction, the shell's history is gone. It just dies on the vine, and your company's history steps in and takes its place. So once you're public, it actually all looks seamless. Your statements look very much like they did historically, and your comparative numbers are your own comparative numbers and not the former public company's comparative. So it is a pretty seamless operation in terms of what it looks like to the public once you've actually gone through it.
Thank you. Sorry, Jason, did you want to add something? You look, please.
I'll just add on top of what David just said. So David spoke about the accounting piece and how all the financial information of the private business carries forward, and the same goes for just its regular disclosure. So just like in the case of an IPO with a prospectus, each exchange has a requirement for a disclosure document that contains prospectus level disclosure as part of the completion of the RTO process. So whether it's a prospectus that gets prepared or a listing statement or a filing statement or some kind of information circular that gets sent to shareholders, you can't get away from the full disclosure requirement and putting full, true, and plain disclosure about the business in a document that gets posted to the public as part of the RTO process. And if I may just take one more moment,
Please.
and just touch on something that Mark said earlier about the benefit of the RTO versus an IPO, and this ties into the markets and market turbulence and whatnot. And so, as Mark said, one of the benefits of an RTO is that the money can be raised privately and it can go into escrow and it gets released to the company once the RTO is completed and the company's approved for trading on the exchange. Whereas in the case of an IPO, the company has to do all the heavy lifting at the beginning and drafting the prospectus and all of that stuff, which I said earlier takes a few weeks to a month, only to then be able to file the prospectus and start marketing the securities. So you're taking a lot of risk on the front end, and if the markets change, then it may not work out for you.
It's a great point.
Just building on Jason's thought there, which is really important. It's partially for that reason as well that some people do view RTOs as being easier transactions to get through and sometimes speedier transactions to get through. And therefore, potentially there could be some cost savings if it takes less time and it's less complex, then it could cost a bit less too. I've seen that go both ways, so that's not gospel. And the other point that I would make is Mark's point that for an RTO, it's also equally important to choose your auditor and your lawyer very well.
All right. A little bit of a shameless promotion, but that's absolutely fine. Jason, you commented on something that's very much in the news today, not so much in Canada, but I'd like to just so we can touch on, so we can differentiate the SPAC, the Special Purpose Corporation. I mean, it seems like everybody in the States, from Jay-Z to Seth Curry, there are celebrity SPACs. I know they've been tried here in Canada. Maybe I just have you start with the concept of what they are. They're a little bit different from an RTO, and then we'll maybe talk a little bit why they haven't been successful here in Canada.
Yeah, so I mean, in some ways, they have been very successful, and in other ways, it's still just a very emerging segment of our capital markets and capital raising process. So as Mark mentioned, Canada is the leader in reverse takeovers, and one thing that we have in Canada is sort of the mini SPAC, which is on the venture exchange. It's the capital pool program where shells can get created to raise. I think now it's up to $10 million, and they raise it as a clean public shell as opposed to an old mining company that may have some skeletons in the closet. So it's like a clean special purpose acquisition vehicle. So it is a mini SPAC in a way, and its sole purpose is to acquire a private business and go public that way. We've seen the TSX and the NEO exchange come up with their own SPAC program where a larger amount of money can be raised than the CPC on the venture, and those have been starting to take off. We've seen some recent listings and whatnot, but it's all sort of testament to this process of going public by way of a reverse takeover, and we've seen that really take off in the U.S. Of late, as you mentioned, Oded.
One add-on comment there, Oded, just on the SPACs, particularly the large SPACs, the formal SPACs. Some of those, they end up raising so much money, and this is a bit nuanced. Again, don't want to bore anybody with a lot of accounting jargon, but they actually turn out to not be RTOs. They actually turn out to be actual acquisitions,
Right.
because they are so loaded up. some of the targets that they acquire are not able to, to be the party in control after the deal is done. And so those that end up being actual acquisitions, accounting looks much different. Unlike everything I said about a shell, the history of the company would then not follow them. So you can get some pretty wonky looking results after that's done. But it is really mainly around the size of the SPAC and how much money they actually have to spend versus what the value of the targets are.
Great. Mark, please.
Yeah, so I'd like to actually go back to RTOs, but it includes SPACs as well. And let's talk about a couple of the negatives to bring in a bit of the balance. I mean, the first one, when markets aren't hot, really hot, is that you often get a bunch of shareholders who are looking for their bump and they're hitting the bid right away. And that ties into one of the implicit costs, which is now recognized under IFRS. It's not actually a cash cost, but the dilution cost. And so that can be pretty significant. And in fact, so if you look at it from terms of the ownership of the business as a whole, the cost actually might be higher to doing an RTO. And in terms of speed, David's absolutely right. It can cut both ways because CICC did data, and we're, the venture, our competitor, many of their listings are done by RTO. And yes, in the last 12 months, or I should say 10 months, it's been that way because of the discombobulation in the capital markets. CICC's experience is pretty balanced, almost a third between IPO, RTO, and non-offering prospectuses, which we'll talk about in a little bit. And so we've done some data, in particular, taken from the middle of 2017 to 2019. And in fact, RTOs generally took longer than IPOs and non-offering prospecti, which was quite interesting. And the cost curve on doing an RTO was actually steeper than for doing an IPO, but the data on costs for IPO were really all over the map. So you couldn't really draw, we attempted to draw a line through it, but the R squared is really pretty low. So, its reliability as a trend wasn't there. And that ties back to what David said about, it really does matter whom you pick, and your experience can vary widely on that. So those are a couple of things. The cost and the time can be different. And Jason made reference to potential liabilities with an RTO. And yes, mining juniors, and I've been involved in one, they can have a risk, but if all they've ever done is early stage mineral exploration, your risks are probably relatively low. You can probably zero in, but you will have a lot more difficulty if the company was an operating company before, because then the liabilities, and I'd like to hear from Jason about how you chase down some of those liability questions when it's been an operating company.
Jason?
Yeah, no, I absolutely. And actually, this ties into one of the questions we got from the audience. I think somebody asked if all shells are the same and what should companies be on the lookout for when evaluating a shell. And I think this is the topic we're on right now. So yeah, no, that's right. I mean, shells have different histories. Some were operating companies. Some are just totally clean and have never operated. Some are mining companies. Some are cannabis companies, and it's really about due diligence. So the private company has to engage the right advisors, whether it be on the accounting side and investment banks and the legal side, to sort of dig in a bit into the prior business and just make sure that any risks related to old liabilities are mitigated as possible as they possibly can. And then it's really just an assessment made by the board of the target company as to whether that shell's the right fit. And different shells are, some are trading on one exchange, some are reporting in only certain provinces. But for example, there could be one that's reporting in Quebec, and then you'll have to translate all your documents going forward. So it's important to look at each of the shell companies, where they came from, where they're listed, are they in good standing? Some shell companies may be cease traded because they haven't filed their financial statements or other disclosure documents on time. And certainly you can reactivate them by filing everything on a go-forward basis and applying to the securities regulator to have the cease trade removed. But there's just more time and costs associated with bringing that in. But that all can get sought off against the dilution factor when the shell and the target are negotiating how much of the public company is left behind in the hands of the former shell shareholders, because the more hair on the deal, the better valuation the target company might get, because they're taking more of a risk and more costs in trying to rectify the old situation. So everything is sort of apples and oranges, and you just sort of weigh it all in and make the best assessment as you can.
Thank you. I was going to ask before, there's lots of questions, we're getting some as well. One of the, I just wanted to touch on one of the probably, I don't want to say least popular, but not well known ways to go public is something called a direct listing. If we could maybe just touch on that, and again, briefly the pros and cons, perhaps why it's not as recognized as others. Mark, could I ask you to start?
Certainly. So, Jason has talked about the becoming a reporting issuer, and David has talked about getting your financials done, your audits. So when you do a non-offering prospectus, you've built your shareholder base using private placement exemptions, and then your objective is to clear a prospectus over time. So rather than wrapping everything together in one event, the way you do with an IPO or in a way you do with an RTO, the pieces are split up, and that makes it far more manageable. I will say at the outset, and by the way, you can get to your shareholder distribution using some of the platforms such as Vested, so it's worth taking a look at. The big risk is that you make the moves toward going public without actually having the capital, and you can find yourself at the end of the road and you don't have the capital. And now you have to continue being a reporting issuer, and you will have that ongoing cost. The upside, or the reason that's not terrible if you are an operating company, is that it can simply defer the process, and you can then trigger the process 6 or 9 months later within your control. So a non-offering prospectus can give you a lot of control over the pacing and the cycle, but you better be careful about, you better think in advance what happens if you don't get all the way there, capital raised, et cetera.
David, do you want to add anything?
Actually, I think Mark did a very good job of outlining, the difference in what that is. I mean, I would comment that they're not used as often, simply because a lot of the companies that are coming to market don't have the requisite number of shareholders and need that distribution as part of their deal. And then, another segment wants to take advantage of raising money on the spot. So, but I do think, obviously, for a specific type of entity and under certain circumstances, as outlined by Mark, it could make a lot of sense. But you do have to be careful with it as you kind of move into it. And decide to go forward on that basis.
Jason, anything to add?
Yeah, I'll just add that direct listings, I see them more commonly when it's like a dual listing, like you have a company that's already public on another in another jurisdiction, like in Australia or the United States or whatnot, and it's looking to get the benefit of the Canadian capital markets. Like there are, for example, cannabis companies that look to the CICC as the place to be. So they want to also list on the CICC, and they'll file a direct listing application, listing statement, and couple it with a non-offering prospectus and whatnot. And so it's just more common in that case where there is that share distribution. They're already used to being public in certain jurisdictions, and it's just more of a seamless process that way.
Thank you. That's a great
Ted?
segue. Oh, sorry. Go ahead, Mark.
Yeah, I just want to raise 2 points that are very relevant to Israeli companies here. And the first is that crowdfunding in Israel is far more robust than it is in Canada. It's more robust both with capital and with number of participants. And we have a company that's coming to us and they're taking the non-offering prospectus route because they built their distribution and their capital already out of Israel using crowdfunding, but they want to be on the Canadian exchange, CICC in particular, because we're such a great portal, and Canada is a great portal to all the rest of the markets. So Israeli companies should take a very careful look at this route because they're able to take advantage of that robust, really robust crowdfunding aspect. And the access to other capital markets, though, there's another aspect we haven't talked about, Reg A Plus in the US. And I don't know how Canadian companies got written into Reg A Plus for automatic approval, but we did. And CICC actually hosted the very first seminar about it in Calgary with a fellow called Ken Sam out of Denver. And there's some very interesting aspects to Reg A Plus. And another aspect, and I want to hear from Jason about this because it entails a corporate inversion. We know of an Israeli company that listed on CICC actually using its own corporate inversion, was a lot more complicated, a lot of more legal expense, but that actually gave them a backdoor into Reg A Plus. So there are these other considerations that you also have to make. What is your objective? If you want access to US capital markets, then think about the aspect, and that may take you back to an RTO if you're a non-Canadian domiciled company.
Jason, before you answer that, perhaps if you can just touch on for our audience, what maybe if you can from a high level, what is Reg A, if you could?
I will do my best.
Okay.
It's a U.S. Crowdfunding exemption. I'm a Canadian lawyer, even though I do understand crowdfunding, but it's a crowdfunding exemption in the United States where companies can raise a bunch of money by filing a document with the SEC, and then they can go to sort of public investors without having to go through the full long form prospectus requirements in the United States. So I don't know all the ins and outs of it, but certainly to Mark's point, it is definitely a benefit of listing on CICC to access capital in the United States once you're public, and you can rely on those exemptions more easily as a Canadian company. So if it's a foreign company, Israeli company, and they can do some kind of inversion and redomicile in Canada to then access capital different ways in different jurisdictions, then yeah, certainly something that should be considered at the front end and as part of the overall planning.
Yeah, so we've touched on, yeah, indirectly, that's what I wanted to get in, if I may. All of you have tremendous experience with Israeli companies, I know, looking to come here, and it doesn't have to be Israeli, but can we talk a little bit about, are there different requirements? I mean, obviously, as I think Jason just said, they needed a foothold here, establish themselves as a Canadian company. Maybe David, you could just start, for foreign companies, hopefully particularly Israeli companies, if we maybe have some of our guests, what do they have to do anything different? What should they look to prepare themselves for going public in Canada?
Yeah, for Israeli companies in particular, it's actually fairly seamless since Israel is already on international financial reporting standards. So country uses pretty much the same framework that Canada uses in its required framework for financial statements that are included in any kind of a disclosure document. The rules are essentially the same in terms of what needs to be produced. So it's still going to be 2 years of audited financial statements and an interim review if one is applicable, and all sort of the other odds and ends of inclusions that are necessary in prospectus level disclosure are required. So there are certainly from a financial information perspective, the rules are actually all pretty much exactly the same. There would be no reason to have any differential in a framework since Israel's already on international financial reporting standards. So Israel in particular, is a great fit. It fits like a glove. It can go public in Canada almost like a domestic company purely from a content perspective, financial information content perspective.
Great.
Yeah,
Jason?
I'll just add to that and clarify one point. So an Israeli company does not need to get a foothold in Canada
Okay,
to go public here. We were just talking about that as sort of a segue into Reg A Plus
right.
in the US. But just from an overall go public process, as you know, as David touched on the financial piece, it's pretty seamless from a legal and regulatory piece as well. I mean, most Israel tech companies, life science companies, cannabis companies, whatnot, mostly do business in English. It's a very mature market. We've been working a lot in the Israeli market for 15 years, trying to inform Israeli companies about the benefits of going public in Canada, and they've become adapted to it. They understand it. A number of companies have paved the way, if you will, and we're seeing them list on a variety of different exchanges and raising a bunch of money and getting the benefits of accessing capital throughout North America by going public on Canadian exchanges. So it's actually a tested and true thing. Like all foreign markets, with the exception of maybe the United States and the UK, there's something when you go through the process called emerging market issuer. Israel still is considered to be an emerging market. So just when you're going through the regulatory and exchange review process, they look a little bit more closely at things like accounting controls and whatnot. But really, it's a very easy to understand jurisdiction, and everyone's become more familiar with it from a lot of the companies that have paved the way in advance of this. So
Yeah.
so we've really now seen a proliferation of companies from Israel go public in Canada, and it's been great.
That's great. Thanks. Mark, did you want to add anything? I know you've done a lot of work as well with Israeli companies.
So first of all, you'll have to take into account if you do an RTO, that you have to get an approval from the tax authorities in Israel, I believe. And Jason and David know far more about that than I do.
Correct, that's right.
You may have to get, if you're a tech company, I'm not sure. I forget what it's now called, formerly called the Office of the Chief Scientist, which was entailed in providing grants, and you may need to get some approval there. CICC takes a, should we say, a more generous approach to emerging markets. So we don't have that kind of burr in our saddle, if you will, about it. And so that really doesn't become an issue. We recognize that auditors in Israel, that David Danziger's Praxity partner, Britt Piquois is a fine CPA firm, but what you will have to do, and David can talk to you about this, you can use your own auditor in Israel for your initial filing, but then you're going to have a CPAB auditor in the longer term. And you want to have a good handle on what those costs will be going forward. I don't want to be prejudiced against Big Four, but you're going to find it with the smaller independents and the mid-sized audit firms. You probably find a better cost-effective fit if you're going to do that. So that does become a point that you want to think about. Coming from those issues are relevant.
Thank you. One of the things we've talked a little bit about, well, obviously Mark comes from the Canadian Securities Exchange. We've mentioned the NEO, we've mentioned the TSX Venture, and we mentioned the TSX, the four major exchanges in Canada. Looking at this, is there a rhyme or reason as to which exchange you should look at or start? Is one better suited for sectors or not? I know we've talked that the CSE is very welcoming of emerging markets and others, but maybe I'll leave Mark for the end on this. I mean, Jason, do you want to start? Is there one sector that's one exchange better than another for sectors or for size of companies?
Yeah, I mean, look, all the exchanges have been doing a great job in getting their message out, and they're competing for listings, and each have their strengths when it comes to different things, and I think it's important for companies to consider all the exchanges, and I mentioned cannabis, and certainly that's a great market. The CSE is a great market, but CSE is great for all kinds of other companies as well. So I wouldn't take anything away from CICC. And as far as TSX Venture, they have the capital pool program, which I talked about earlier, which is great. The TSX is the larger, more well-known, established exchange that's been around the longest in Canada. NEO is sort of a newer entrant into the market, and they've done a good job in getting their message out and starting to see more listings there. So I think it's important to consider them all. And there's no hard and fast rule as to which exchange to list on. I think it's whatever's going to provide the best value for the company, looking at its specific circumstances. Just like a company in the US is considering, NASDAQ or New York Stock Exchange or whatever. It's really just what makes the most sense for that company in particular.
David, would you like to add anything?
Sure. I mean, I would certainly echo Jason's comments. You have to make an overall analysis of what's right for the business at hand. I mean, it's somewhat easy to delineate between the TSX, the NEO, and then on the other side, the CICC and the TSX Venture, because one's a senior board and one's a venture board. And a lot of companies, are just not ready for the senior board for one reason or another. Either, don't meet the rules, are not ready for the shorter timelines that are required in reporting on a regular basis. There's numerous reasons that need to be analyzed, as to whether or not you should be on a senior board or a venture board. And then when you sort of get down to the fact that you got a better home on a venture exchange, then, I guess, as Jason said, you need to do an analysis of both and see which one is a better home for your business. I would point out that, one of the things that I found striking, Mark, was that graph that you had reflecting that the CICC had, it was almost equal in the three methods of going public, which I found very unusual and bucking the trend, which I think is probably significant in the sense that, it's reflective of the CICC being a venture exchange that has bucked the trend and has gotten itself deeply involved with things like Reg A, et cetera, which brought about, more popularity in taking different ways of going public and accessing them rather than just always heading to the RTO. So I think that's reflective of, of the CICC's personality, if you will, and its history. And so, when I thought about it, it kind of made sense that would be the one exchange that probably has a different experience in the level, just in the methods of going public than the other exchanges.
Mark, did you want to comment?
Well, thank you for that, David. And yes, we don't tend to put people in a whole series of shoeboxes. And our philosophy is also perhaps more the way of an exchanges used to be. We don't try to be the gatekeeper. We require more disclosure than other exchanges, but we get out of the company's hair. And I think especially for companies that are thinking of doing acquisitions, that's vitally important, because on other exchanges, you can be held up for review, for instance, if you issue shares as part of a tuck-in acquisition. Not such a big deal if you're an oil and gas company. There'll be very little dispute between the regulator and the company and the independent consultant, because everyone's using the same price deck off the CME futures, and everyone's using a similar discount rate. So very rarely a valuation argument. Mining, you get a bit more of a valuation disagreement, and you might have a disagreement between the exchange and the company management as what they should be paying for this other acquisition. But if it's technology, the room for a disagreement goes from here to there, right? And more critically, unlike with oil and gas and minerals, where the minerals or the hydrocarbons tend to stay in one place in anthropogenic time, in tech, time is vital. And because CICC gets out of the way when you're doing things, we just want full, true, and plain disclosure. We're not interested in second guessing management strategies, business commercialization, business rollout, or the valuation. The valuation is what you and the investors agree to. So in particular for tech companies, our value proposition really comes to the fore in that case.
Great, thank you. Now, in the interest of time, I want to keep it down to an hour, be respectful of our guest speakers as well as everybody else. But I think one thing we haven't talked a little bit about, which is a little bit important, is the cost. And again, is there, if maybe and all three of you come from different aspects of it and are part of the cost of legal, the accounting, and the registration, perhaps talk a little bit about what someone can expect from cost and timing of the work. And I realize each situation is different, as we've talked about, but is there a guideline that we could look if someone's looking to take their company public in one form or another? Maybe Jason, I'll start with you. Always the legal costs are so important. So what can a small company or a company expect to pay?
Yeah, so it's hard to quantify it, and I know it's not the answer that people like to hear. They want a number, right? Everybody wants a number. But I've made it my practice not to give a number, especially on a very broad webinar. But you know, what I would say is that it's going public, however way you do it, is a tremendous milestone for the company. It's a tremendous undertaking. There's all kinds of work on the legal side, and I'll restrict my comments to the legal side as far as getting ready to go public. You know, and that comes to the initial structuring, getting all your ducks in a row, healing up, you know, getting those employment agreements in place, getting, you know, settling any old litigation, getting your corporate records up to date, getting your IP perfected, if in the case of a tech company, all of that stuff. And then you got to draft your prospectus and your business plan. So the lawyers can do, you know, more or less, whatever's needed by the company, right? Depending on what their budget is and how much bandwidth they have. There's a tremendous amount of work. Then there's the whole offering piece. That's raising the money. And then it's common for the companies to also pay the legal fees of the underwriters who are going to be doing due diligence on the company. In fact, I wouldn't say it's common. I'd say it's always. And so there's just a lot of legal costs in going public, and you can expect those costs to be somewhat significant because it is such a tremendous milestone in the company. And it looks like we're running out of time, so I'll give the ball over to the next.
So Jason's managed to dance around giving an answer, and that's great, like every good lawyer is. David, is there anything from your perspective?
Yeah, I'm probably not going to be that helpful here because my own experiences, you know, I've seen audit fees on a go public anywhere from $25,000 to over $1 million. You know, you sort of, you know, take a highly complex US based cannabis company that's never been audited before, doesn't have great records, you know, and it just becomes a ceremony. I will say this, the financial statements, audits, and the other work that has to go into them is generally the #1 bottleneck in a go public transaction. So anybody that's thinking about going public, one of the first things you should be thinking about is, have I been audited yet? And if I haven't been, I better start looking at that regardless of whatever else I'm doing, because it will inevitably end up holding up your transaction if you're not ready for it.
Great. Mark, maybe it's a little bit easier for you.
Well, I'll just say that one of the first, I started consulting to CICC back in 2003, and one of the first seminars we had was preparing for your audit by MNP, I should add, David. And in fact, not being ready for your audit increases your legal costs too. And the other thing it does is it pushes everybody away, because if you're not ready there, then you're not ready for the next person, and your file starts to go further and further down. And then if there's a dealer involved in raising your capital, now the dealer might start to have questions about you and your capability, but it pushes everything. Then the deal goes infinitely slower, right? It's almost like a square function. But I will also comment on a couple of other items. We find, because our policy manual is a fraction of the length of the ventures, that legal costs run anecdotally between 40 and 60% of what they would be on the venture. And the deal goes to the top of the lawyer's pile because they know that it's going to be dealt with like that, and that there won't be roadblocks because of these other disagreements. But the other costs you have to think about, you may have a really good CFO, but you might need to supplement that possibly with a contract CFO or consultant who knows how to do the public company filings, et cetera. That's really worth having, and it will be a cost. One of the innovations of Canada is slicing and dicing these services. So there are a lot of CFOs who do this for up to a dozen companies, for instance. And the distraction cost for the CFO, CEO, and the management team, that really cannot be discounted. There is a distraction cost in going public. Sometimes you get a benefit if you're one of these companies that has customers who are also potentially your investors. Can be self-reinforcing. That can be really ideal as a reason for going public. So then the costs can sort of pay for themselves or pay in part for themselves. And finally, I would say be very careful about your IR expenses. You can overspend on IR. IR is probably the one area where value for money is most often not achieved. And I'll leave it at that.
Gentlemen, listen, it's 12:01, and again, I know we've gone a little bit over time. I want to thank all three of you for taking time out of your busy schedules. I think it's been tremendously informative for myself, and I can't tell you how much I appreciate it very much on behalf of myself and all the members of the Canada Chamber of Commerce, and to our attendees. Thank you all for listening and participating. There were some questions we didn't get to. If you email us, we'll definitely pass those on and to the speakers, and we'll get answers for you. And we look forward to seeing everybody, not seeing unfortunately, but seeing your names at our next event, which is March 11th. And again, that is going to be helping Ontario companies do business with Israeli companies. We've got a great lineup scheduled and expect to see some of the advertising and the marketing for that in the near future. So again, thank you, gentlemen. Appreciate it. Please, everyone, stay safe, stay positive, and look forward to seeing everybody in the near future live. Thank you.
Thank you.
Bye now.